Last time, we investigated how the three-peak volume pattern varies across different forex currency pairs and considered both why that variance occurs, but also started to think about the implications of this for how we can use volume data to improve our trading decisions. Today, we do the same, but this time for stock indices and commodities. Stay tuned. So, following on from our analysis of forex currency pairs last time, let's now take a look at the way that volume data patterns vary across different stock indices and commodities, and also continue the theme of considering how we can incorporate this into our analysis to make better trading decisions. So again, we have to remember that the basis for volume data analysis is around those regular patterns that exist throughout every trading day. And the very basic pattern is what I call the three-peak pattern. But last time we saw how the relative size of each of these peaks varies for different types of currency pair. And that's important to know, because when we perform our analysis, it's imperative that we're comparing the current volume to the average volume for that currency pair that we're intending to trade. And so here is a representation of the 5 pairs that we looked at last time. And you can see those that have the yen or the Australian dollar as part of that have a much higher traded volume during the Asian session, whereas the purely American pair, dollar CAD, has a much higher peak for the US session. And in that last episode, there were also some other characteristics of these that we looked at. So let's now turn our attention first to stock indices. Now, the example I'm going to use here is the UK FTSE 100. And the first thing that I want to bring your attention to is that the pattern no longer conforms to the symmetric type 3-peak pattern. There's still 3 peaks, but the pattern has changed so that there's a very rapid increase in the volume at the beginning of trading sessions. And then that volume gradually decreases throughout the session, causing this non-symmetric look. And so straight away, you can see here that if you were performing analysis of volume data for a stock index, you'd need to take into consideration this difference in order to accurately compare the current volume to work out if that was higher or lower than normal. Now, once again, just like the Forex charts that I showed last time, I'm not looking here at volume data for a single day. This is volume data that's being averaged out over 22 trading days. So this gives us a reasonable average. And then following that averaging process, we're now looking at a full 24-hour period. So like we did last time, let's now overlay 2 of the main sessions, the European and the American sessions. And this gives us some level of insight into why the volume changes in the way that it does. So the FTSE 100 is obviously traded predominantly in London, and this peak here coincides with the London Open. Now, the peak that you see here coincides with the New York Open, but in many respects this is completely overshadowed by the Chicago Open, which shows a significant increase in traded volume, almost equal to that of London. And then interestingly, the peak that you see here coincides with the London close. So presumably traders closing off positions at the end of the day and so on. And so these sharp rises in trading volume are an effect caused by the fact that there are standard trading hours with an open and a close, whereas with Forex, of course, that doesn't exist. They can theoretically be traded 24 hours per day. And so that's the explanation for why we see this non-symmetric 3-peak pattern for stock indices. So let's now compare this to the Dow Jones. So we see quite a big difference here, in that it's that traded volume at the American Open that is massively dominant in this pattern. Interestingly though, this is almost classified, I think, as a 4-peak pattern, because this final volume peak where the US session ends is actually bigger than the Asian and the European Open volume. And so because of this, we have to consider this a 4-peak pattern and perform our analysis accordingly. Let's now look at the Japanese Nikkei, and as we might suspect, the traded volume here is more in the Asian session. But remember, this is a pattern that we didn't see with the Asian-based currency pairs. When we looked at Australian dollar, Japanese yen, there was still more traded volume of that in the European and US sessions. But here, clearly that's not the case. Trading of this during the European session is generally quite low, and then it does pick up a little for the US session. And so the key takeaway here is that across these 3 stock indices, there is a huge variance in the patterns that we see. And so when performing volume analysis, it's absolutely imperative that we compare the current volume of the asset we're intending to trade against its average volume in the past. Let's now move on to commodities, and we're going to look at gold. So here the Asian and European sessions are much more on a par. But because this is the dollar traded gold, again we might expect that that would show more volume during the US session, which it does. If we now move over to silver, we notice that the pattern is extremely similar. And given that they're both precious metals, maybe that's understandable. But if we took a look here at oil or natural gas, then those patterns would exhibit differences that would need to be taken into account. And by looking at these two side by side, you can see how similar they are. Now, the way that the volume patterns vary is important. And as we said before, it's impossible to gain intelligence to inform trading decisions without taking the individual patterns into consideration. And that's what I start to look at in the next episode. Quantitatively assessing relative volume per symbol to help inform trading decisions. And it's by doing that that will enable us to turn those probabilities slightly more in our favour based on that additional intelligence that we can gain. Now, just to look ahead a little bit further, in the following episodes, I'm going to be looking at special cases and exceptions to the basic principles. And there are 3 that I'm going to focus on: volume spikes, trend exhaustion, and below average volume. And when any of these are occurring, we need to adapt our rules slightly in terms of how we assess that information. So hopefully you've got a good idea there of where we're going to with this new mini-series, and I hope that you're starting to get some value from the episodes that we've already looked at. If that's the case, then please do remember to give me a like for each of those episodes. And now until next time, trade safe.